Index funds, the financial equivalent of eating your vegetables, going to bed at 9, and flossing every single day. The responsible choice, the smart choice, the thing every personal finance influencer, every financial advisor, and every person who's ever read one book about money will tell you to do without hesitation. Buy a low-cost index fund, hold it forever, and don't touch it. That's the whole strategy. That's the genius. That's the plan that supposedly separates the disciplined investors from the delusional ones day trading meme coins at 2 in the morning. And look, for a long time, it worked. It still works for millions of people. I'm not here to tell you index funds are a scam. I'm here to tell you something far more uncomfortable. I'm here to tell you that index funds have gotten so popular, so enormous, and so dominant that they might be quietly breaking the very market they're supposed to track. And the worst part? The more people pile in, the worse it gets. And nobody is talking about it because boring things don't get clicks. So let's fix that. Because what's actually happening underneath the surface of passive investing is one of the most dangerous feedback loops in modern financial history. And it's dressed up as the responsible thing to do, which makes it nearly impossible to see coming. Let's start with the basics. An index fund is a fund that tracks a market index, like the S&P 500, which is made up of the 500 largest publicly traded companies in the United States. You buy one share of an S&P 500 index fund, and you effectively own a tiny sliver of all 500 companies at once. Low fees, instant diversification, no stock picking required. Simple, but here's the thing most people don't know. The S&P 500 is market cap weighted, which means the bigger the company, the more of your dollar goes into it. If Apple makes up 7% of the S&P 500, then for every dollar you put into an S&P 500 index fund, 7 cents goes straight into Apple, whether you want it to or not, whether Apple deserves it or not. And right now, the top 10 companies in the S&P 500 make up roughly 37% of the entire index. That means more than a third of every dollar flowing into passive index funds is being shoveled into the same 10 stocks over and over and over again. That's not diversification. That's a very polite way of making the same concentrated bet 10 times. Now, here's where it gets interesting, because passive investing has absolutely exploded. In 2009, passive funds held about 20% of the US equity market. Today, that number is over 50%. More than half of all US equity assets are now sitting in passive index funds, and the inflows aren't slowing down. Every month, billions of dollars pour in from 401k contributions, automated investment apps, and people following the advice they read in every personal finance book ever written. And every single one of those dollars gets allocated based on market cap, automatically, mechanically, without any opinion, any analysis, or any judgment about whether a stock is cheap or expensive, which means the bigger a company gets, the more money flows into it. The more money flows into it, the bigger it gets. The bigger it gets, the more it dominates the index. The more it dominates the index, the more money flows in. It's a loop, a beautiful, clean, self-reinforcing loop. And like most beautiful things in finance, it's gorgeous right up until it isn't. Meet the Magnificent Seven. Apple, Microsoft, Nvidia, Amazon, Meta, Google, and Tesla. 7 companies, 7 stocks. And because of passive investing's feedback loop, these 7 companies have become the gravitational center of the entire US stock market. The S&P 500 has returned around 170% over the last decade. Sounds impressive. But strip out the top 10 companies and the equal-weighted index, the version where every company counts the same has significantly lagged the cap-weighted version. What that tells you is that the index's performance isn't broad-based growth. It's 7 companies doing most of the work, while the other 493 companies clock in, clock out, and collect a participation trophy. And the scary part isn't just that the index is top-heavy. It's what happens to price discovery. Price discovery is the process by which markets figure out what something is actually worth. It's the mechanism that's supposed to keep everything honest. Investors research companies, model earnings, assess risk, and buy or sell based on conclusions. That collective judgment is what sets prices. It's what keeps valuations anchored to reality. But passive investing doesn't do any of that. When you buy an index fund, you're not making a judgment about Nvidia's earnings growth or Apple's competitive moat. You're just buying the whole basket automatically because it's Tuesday and your 401 key contribution came through. There's no judgment, there's no price signal, there's just capital flowing in proportion to existing size. Which means the bigger something already is, the more money it gets, regardless of whether it deserves it. In other words, passive investing has quietly started to remove the brakes from asset prices. And as passive's share of the market grows past 50%, we're entering territory where the market has less and less of its own opinion and more of its money on autopilot. Warren Buffett's longtime partner once called this the most important financial development in recent decades, and not in a good way. Because when the crowd stops doing their own thinking and just copies the index, the price signal that makes markets work starts to degrade. And here's the gut punch. Nobody is going to stop it, because for any individual investor, continuing to buy index funds is still the rational decision. The fees are low, the historical returns are solid, and no one wants to be the person who stopped buying right before the market went up another 30%. So everyone keeps doing it. And the feedback loop keeps spinning, and the concentration keeps building, and the risk keeps accumulating in the same handful of names. This is what economists call a coordination problem. Everyone acting rationally in their own interest produces an outcome that's collectively irrational, and markets are full of these. They just don't announce themselves until after the fact. Now, here's the question everyone wants answered. What happens when it unravels? Because here's the thing about feedback loops. They work beautifully in one direction, and they work catastrophically in the other. When passive money floods in, the biggest stocks go up, which attracts more capital, which pushes them higher. Fine, we've been watching that movie for 15 years. But when something triggers a sustained outflow, the same mechanism runs in reverse. People sell their index funds. The funds have to sell holdings proportional to the index. The biggest stocks get sold the hardest. The biggest stocks falling drag the index down, which triggers more selling, automatically, mechanically, without any judgment about whether the prices are fair. Think about that. A retiree in Ohio panicking about their 401 kick and hitting sell doesn't cause a localized problem. Because of how index construction works, their sell order ripples directly into Apple, Microsoft, Nvidia, and the rest of the top 10, amplifying their decline regardless of whether those specific companies deserve to fall. The 1987 crash had something similar. Portfolio insurance, a then popular strategy, was basically an automated selling mechanism that was supposed to protect investors. What it actually did was add mechanical, indiscriminate selling pressure exactly when the market needed rational buyers. Markets fell 22% in a single day. The strategy designed to reduce individual risk created a systemic one. We haven't seen what the passive investing feedback loop looks like in a true sustained bear market. The 2020 crash was too fast and too short. The 2022 correction was bad but not catastrophic. The real test hasn't arrived yet. And when it does, we might find out that the most popular investment strategy of the last 20 years was accidentally building a bigger pressure valve than anyone realized. So what does this actually mean for you? Because here's the part nobody gets to in these conversations. First, diversification isn't what it used to be. If you own 3 different S&P 500 index funds thinking you're diversified, you're not. You own the same top 10 companies 3 times with slightly different packaging. Second, the equal-weighted index is worth knowing about. Unlike the cap-weighted S&P 500, the equal-weighted version spreads exposure across all 500 companies equally. More volatile, but genuinely more diversified. Third, international exposure is being quietly underweighted. Because global passive money has disproportionately flowed into U.S. equities, U.S. markets are expensive relative to nearly every other developed market on the planet right now. At some point, that gap closes. Fourth, concentration risk is real even inside a diversified vehicle. People assume index funds eliminate single stock risk. They do. What they don't eliminate is single sector risk, single country risk, or the systemic risk that comes from half the market acting in lockstep. Fifth, the exit matters as much as the entry. Understanding why you would sell and under what conditions is not pessimism. It's the part of the strategy most passive investors have never actually thought about. None of this means index funds are bad. They're still, for most people, a rational long-term vehicle. But the narrative that they're risk-free, fully diversified, and permanently safe has become its own kind of blind faith. And in finance, blind faith is almost always the thing that sets up the next problem. Because the funny irony at the center of all this is that index funds became dominant because they were the antidote to human overconfidence. They were the product built on the idea that nobody can consistently beat the market, so stop trying. And that was right. But now, their dominance has created a new kind of overconfidence. The confidence that the market goes up, that diversification is handled, and that the boring choice is always the safe one. Markets don't behave like this when the future is clear, and that's worth keeping an eye on. So here's where I want to hear from you. Do you think passive investing's concentration problem is A, a legitimate systemic risk that could amplify the next downturn, B, overblown because markets have always adapted to new structures, or C, something that matters but only when you're close to actually needing the money? Drop your take in the comments because the range of answers on this one is going to be genuinely interesting.